Major refiners across America, the institutions that have processed silver for decades, are turning away sellers at the door, not because they don't want the metal, but because they cannot pay for it. Their credit lines, exhausted. Their bank accounts, frozen at capacity. In China, silver commands $150 per ounce. In America, $32. The same metal, two different worlds, one broken system. What happens when the infrastructure that makes markets possible can no longer access cash? Welcome to John A.G. If you've been in business long enough to remember when a bank manager knew your name, when credit was extended on character, not just algorithms, when a handshake still closed deals, then you'll understand why this channel exists. We don't chase headlines. We document the quiet failures that reveal systemic fractures. If that resonates with the way you assess risk and opportunity, we'd be honored to have you subscribe. Not because we ask everyone, but because we are building a community of serious observers who understand that the most critical market signals are not found on financial news networks. They're found in the refusals, the unexplained shutdowns, the transactions that quietly fail. Before we continue, drop a comment and tell us, where in the world are you watching from today? Because geography now matters more than it has in half a century. There are moments in financial history when a single failure reveals everything. A bank declines a loan, a clearinghouse rejects a payment, a refiner refuses to buy silver. This is one of those moments. Across the United States, precious metals refiners have begun refusing purchases of 90% silver coins. Not occasionally, not selectively, systematically. These are the same refiners who built their entire business on buying every piece of silver they could process. For decades, constitutional silver, those pre-1965 American coins containing 90% silver content, has been the foundation of their operations. It has always been reliable inventory, easy to process, easy to sell, until now. To understand why this matters, one must first understand what a refiner actually does. A refiner is not a speculator. They do not bet on whether silver prices will rise or fall. They are infrastructure. Their business model is mechanical and simple. They purchase silver at spot price minus a small discount. They process it into 999 fine silver. They sell it at spot price plus a small premium. Then they repeat the cycle. The profit margin is narrow, typically 2 to 4%, but the volume is enormous. And for generations, the business has been stable and predictable. Refiners compete aggressively for silver supply. They advertise their services. They offer competitive rates. They maintain long-term relationships with coin dealers, estate liquidators, and private holders. In their world, silver is not something to fear. It is inventory to be processed and moved. So when multiple refiners simultaneously stop purchasing 90% silver, when they turn away sellers holding cash, when they offer no explanation beyond, "we're not buying right now," that is not a market decision. That is a structural failure. The first reports came from regional coin dealers in the Midwest. Dealers who had worked with the same refiners for 20, sometimes 30 years, suddenly found their phone calls unreturned. Their emails received vague responses. Their truckloads of constitutional silver were rejected at loading docks. Then the pattern spread. East Coast refiners, same story. Texas facilities, same response. West Coast processors, same refusal. This was not a regional problem. This was a system-wide constraint. Now, here is where the analysis becomes critical. When a refiner refuses to buy silver, there are only two possible explanations. Either they believe the price is about to collapse and they do not want to hold inventory, or they lack the financial capacity to make the purchase. The first explanation fails immediately. If refiners believed silver prices were about to fall, they would accelerate purchases, not stop them. The logic is simple. Buy low, process quickly, sell before prices drop further. That is how commodities businesses operate during anticipated price declines. But they are not buying at all, which leaves only the second explanation. They lack the financial capacity to purchase. But how can a refiner whose entire business is buying and processing silver suddenly lack the capacity to do so? They have not changed. The silver has not changed. The demand for refined silver has not disappeared. What has changed is access to credit. Refiners do not operate on cash reserves. They operate on credit lines extended by banks. When a dealer brings in 10,000 ounces of constitutional silver, the refiner does not pull cash from a vault. They draw on a revolving credit facility. They purchase the silver, they process it, they sell the refined product, they repay the credit line. The cycle continues. But what happens when the credit line is maxed out? When the bank says no more extensions? When the revolving facility stops revolving? The refiner stops buying. Not because they do not want the silver, not because the business model has failed, but because the financial system supporting that business model has frozen. This is not about silver. This is about credit. And when credit freezes for infrastructure businesses, businesses that make markets function, the implications extend far beyond one commodity. Because if refiners cannot access credit to buy silver, what else in the commercial system is quietly failing to settle? The refiner's refusal is not the problem. It is the signal. The question now becomes, what is actually breaking in the credit system? And how deep does the freeze extend? Behind every functioning market lies a financial mechanism most people never see. Consider a Tuesday morning in Ohio. A coin dealer walks into a refiner's facility carrying 200 pounds of constitutional silver, dimes, quarters, half dollars. In normal circumstances, this transaction takes less than an hour. The silver is weighed, the purity is verified, the dealer receives a check or wire transfer. By evening, that silver is in the refinery's processing queue. But there is something most people do not realize about this seemingly simple transaction. The refiner does not actually have $96,000 sitting in a bank account waiting for silver purchases. What they have is a credit line. This distinction is everything. A refiner operates on what financial professionals call working capital financing. They maintain revolving credit facilities with commercial banks, typically ranging from $5 million to $50 million, depending on the size of their operation. These credit lines exist for one specific purpose: to purchase incoming precious metals inventory. The mechanics work like this. When the Ohio dealer brings in his silver, the refiner contacts their bank. They request a draw on their credit line for $96,000. The bank reviews the request against the refiner's existing balance, their credit limit, and their repayment history. If everything is in order, the bank approves the draw, the refiner pays the dealer, the silver enters processing. Within 3 to 7 days, that silver is refined into 999 pure bars. The refiner sells those bars to industrial users, jewelry manufacturers, or investment dealers at spot price plus a small premium. The sale generates revenue. The refiner repays the credit line. The cycle resets. This is not unusual. This is how commodity processing businesses operate across every sector. Grain elevators, scrap metal processors, timber mills, they all function on credit-based working capital because their business requires them to purchase large volumes of raw material before they can process and sell finished products. The system works when credit flows. But what happens when the credit line reaches its limit? What happens when a refiner has already drawn their full credit capacity and cannot access additional funds? The answer is simple and devastating. They stop buying. And this is precisely what has occurred across the United States precious metals refining sector. Multiple sources within the industry, dealers who have supplied refiners for decades, report the same pattern. Credit lines maxed out, banks refusing to extend additional capacity, processing facilities sitting with partial inventory because they cannot afford to purchase more. One dealer in Pennsylvania described calling a refiner he had worked with for 18 years. The refiner's response was direct. "We want your silver, we just can't pay for it right now." Another dealer in Nevada reported similar conversations with 3 different refineries in the same week. All 3 gave variations of the same explanation. Credit constraints, bank limitations, processing capacity available but financial capacity exhausted. This reveals something critical about the current situation. The refiners are not failing. Their equipment still works. Their expertise remains intact. Their customer base has not disappeared. The demand for refined silver products continues. What has failed is the credit mechanism that allows them to operate. But why would banks suddenly restrict credit to refiners? These are not speculative businesses. They are not high-risk ventures. For decades, precious metals refining has been considered stable, low volatility, infrastructure-level commerce. The answer lies in how banks assess risk during periods of financial system stress. When uncertainty rises in credit markets, banks do not simply raise interest rates. They reduce exposure. They pull back from entire categories of lending. They freeze credit lines at current levels and refuse to extend new capacity, regardless of the borrower's history or reliability. This is what happened in 2008. Credit did not become expensive. Credit became unavailable. And the first sectors to experience credit withdrawal are those involving physical commodities, because banks view inventory-based lending as risky during uncertain times. It does not matter if the refiner has a perfect repayment record. It does not matter if precious metals are considered safe assets. What matters is that the bank's own liquidity is constrained, and they are reducing all commodity-related credit exposure. The refiner becomes collateral damage in a broader credit freeze. And when infrastructure businesses lose access to credit, markets do not just slow down. They stop functioning entirely. On the same day, at the same hour, 2 transactions occur. In Shanghai, a buyer purchases 100 ounces of physical silver. The price, $150 per ounce. Total cost, $15,000. The transaction settles immediately. The silver changes hands. The deal is complete. In New York, a different buyer purchases 100 ounces of physical silver. Same metal, same purity, same weight. But in one market, silver costs nearly 5 times more than in the other. This is not a misprint. This is not a temporary glitch. This is the current reality of global precious metals markets, and it reveals something broken in the foundation of international commerce. Under normal market conditions, price differences between geographic markets create arbitrage opportunities. When gold costs more in Dubai than in London, traders buy in London and sell in Dubai. The price gap closes. This is basic market mechanics. Supply moves toward higher prices. Demand moves toward lower prices. Equilibrium is restored. But that is not happening in silver markets. The price gap between Eastern and Western silver markets has not only persisted, it has widened, month after month, week after week, day after day. Professional traders call this an arbitrage failure. When obvious profit opportunities remain unclosed, something is preventing the market from functioning normally. The opportunity is clear. Buy silver in New York at $32 per ounce. Ship it to Shanghai, sell it at $150 per ounce. The profit is $118 per ounce before shipping and insurance costs. Even accounting for logistics, the margin is extraordinary. So why is no one doing it? Because the arbitrage requires three things that currently do not exist in combination: available physical silver in Western markets, credit to finance the purchase and shipment, and settlement systems that can complete the transaction. Western refiners cannot buy silver to export because their credit lines are maxed out. Western dealers cannot access inventory because refiners are not processing. Western banks cannot finance shipments because they are reducing commodity credit exposure. Meanwhile, Eastern buyers continue purchasing at premium prices because they are not buying paper contracts, they are buying physical metal, and they are willing to pay whatever price is necessary to secure actual delivery. This creates a two-tier market structure that has not existed at this scale since the gold standard era. In Western markets, silver trades primarily on paper: COMEX futures, ETF shares, allocated accounts, unallocated accounts, banking system credits. The price reflects supply and demand for contracts and claims, not necessarily for physical metal. In Eastern markets, silver trades as physical inventory: bars, coins, vault storage. The price reflects supply and demand for actual metal that can be held, stored, and transferred outside the banking system. When both systems functioned smoothly, prices remained relatively aligned. Small premiums existed for physical delivery, but the gaps were minor: 5%, maybe 10% during periods of high demand. A 400% gap is not a premium. It is a dislocation. And dislocations of this magnitude signal that the two markets are no longer connected by functional arbitrage mechanisms. Historical precedent offers context. In 1980, during the Hunt brothers' silver manipulation, prices spiked to $50 per ounce in New York while remaining lower in international markets. But that was a manipulation-driven anomaly. It corrected violently when the manipulation collapsed. In 2011, during quantitative easing concerns, silver briefly touched $48 per ounce. Physical premiums rose to 15-20% over spot, but arbitrage mechanisms still functioned. The premium compressed within months. In 2020, during pandemic disruptions, physical silver became difficult to source. Premiums reached 30-40% over paper spot prices, but refiners were still buying. Processing continued. The system remained intact. What makes the current situation different is not the price level. It is the refiner refusal combined with the price dislocation. Western infrastructure has stopped purchasing the metal that Eastern markets are paying massive premiums to acquire. This is not rational market behavior. This is evidence that Western precious metals markets are experiencing a credit and settlement crisis that prevents them from responding to price signals. The question is no longer why Eastern silver costs more. The question is why Western institutions cannot capitalize on the opportunity, and what that reveals about the stability of dollar-denominated commodity markets. Because when markets cannot clear price differences this large, the problem is not in the commodity. The problem is in the currency system itself. When infrastructure stops working, the wise observer does not ask when it will restart. The wise observer asks what broke and what else depends on the same mechanism. The refiner's refusal to purchase silver is not an isolated incident. It is a symptom, and symptoms cluster when systems are under stress. Consider what has been documented across these three parts. Refiners across multiple states have maxed out their credit lines. Banks have frozen commodity financing at current capacity levels. A 400% price gap exists between Eastern and Western silver markets, and arbitrage mechanisms that should close such gaps have failed entirely. Each fact alone might be dismissed as an anomaly. Together, they form a pattern. And the pattern points to a credit system operating at the edge of functionality. Business leaders who have navigated previous financial crises recognize this signature. It appeared in 2008 when overnight lending markets seized. It appeared in 1998 when long-term capital management collapsed. It appeared in 1987 when portfolio insurance strategies broke the clearing systems. The signature is always the same. Institutions that provide market infrastructure, the unsexy mechanical businesses that make commerce possible, suddenly cannot access the credit they need to operate. not because they are failing, but because the financial system supporting them is contracting. This matters far beyond precious metals markets. If banks are restricting credit to refiners, businesses with decades of stable operating history, physical collateral, and mechanical business models, what credit are they restricting elsewhere? The evidence suggests they are restricting everywhere. Commercial real estate refinancing, equipment leasing for manufacturers, inventory financing for wholesalers, working capital lines for distributors. All of these depend on the same credit mechanisms that have just failed precious metals refiners, and all of these businesses operate the same way refiners do. They purchase inventory or assets using credit, they process or hold those assets briefly, they sell them, they repay the credit line. The cycle continues until the credit stops. For business leaders, this creates a strategic decision point. The traditional approach during uncertain times is to wait for clarity, wait for official announcements, wait for market stabilization, wait for confirmation that conditions have truly changed. But waiting for confirmation means waiting until the problem is obvious to everyone. And by the time credit freezes become obvious, they have already locked in place. The strategic advantage belongs to those who recognize structural signals before they become headlines. So what are the actionable indicators? First, monitor credit availability in one's own industry. Are banks taking longer to approve routine credit lines? Are they requesting additional documentation for transactions they previously approved automatically? Are they reducing credit limits without clear justification? These are not random administrative changes. These are banks reducing exposure. Second, observe transaction settlement times. Are payments that normally clear in 1 day now taking 3? Are wire transfers requiring additional verification? Are clearinghouses requesting more collateral? These are signs that settlement systems are experiencing stress. Third, watch for infrastructure failures in adjacent markets. When refiners stop buying silver, when scrap processors reduce intake, when commodity warehouses restrict deliveries, these are not isolated business decisions. These are symptoms of credit constraint moving through the commercial system. Fourth, distinguish between price signals and structural signals. Prices fluctuate. That is normal. But when prices diverge wildly between markets that should be connected, when arbitrage fails to function, when physical delivery becomes difficult, those are structural problems, not price movements. And structural problems do not resolve through market corrections. They resolve through system resets. For the business community, the implication is clear. This is not about silver prices. This is not about precious metals investment strategy. This is not about whether gold or silver will rise or fall. This is about credit system functionality. And credit system functionality affects every business that operates on working capital financing, every transaction that requires settlement, every contract that depends on counterparty performance. The refiner's refusal is documentation, not speculation. It documents that credit mechanisms are failing for infrastructure businesses. It documents that price discovery systems are breaking down across geographic markets. It documents that the financial architecture supporting physical commerce is under stress. Those who understand what infrastructure failure signals will position accordingly, not with panic, not with speculation, but with strategic recognition that when systems stop working quietly, the public failure is already inevitable. The only question is timing.